All right, get this. Today we're diving headfirst into TRAs. And no, before you picture those comfy pants everyone was living in a few years back, we're talking tax receivable agreements.
Oh, those are interesting.
It's a fascinating and surprisingly relevant corner of finance, especially for those like you who value getting a grip on complex topics quickly.
And what's so captivating about TRAs is that, they're like the secret sauce behind a lot of IPOs,
Yeah.
even if most people have never even heard of them.
It's true, like this whole other layer of financial engineering going on behind the scenes.
Right.
And lucky for us, we've gotten our hands on this brand new white paper from Andy Lee. He's the CIO of Parallax's Capital.
Okay.
And these guys, they're practically swimming in TRAs, experts at monetizing them, so we're getting insights straight from the source.
And this isn't just, some dry textbook stuff.
Yeah.
Understanding this white paper could be incredibly valuable.
Yeah.
Think of it like this. It's like we're handing you a treasure map.
Okay.
And Andy Lee, he's our expert guide, giving us the lay of the land before you go hunting for gold.
I like the way you think. Okay, so let's start with the basics. What exactly is a TRA? So imagine a company, fresh off a successful IPO.
Right.
They're sitting on a pile of potential tax savings. A TRA allows them to essentially sell the rights to those future tax benefits to investors for cold, hard cash up front.
It's a bit like pre-selling a portion of your future tax refund.
Okay.
You get the cash now, maybe to reinvest in your business, make some strategic moves, and the investor.
Yeah.
Well, they're betting on your company's ability to generate those tax benefits down the line.
And that's what makes it interesting for both sides. The company gets to access capital they wouldn't normally have right away. The investor gets a potentially lucrative opportunity. Now, Andy Lee's white paper, it paints this really intriguing picture of the current state of the TRA market. Remember how everyone's been talking about the IPO slowdown?
Absolutely. IPO activity definitely took a hit last year, which you'd think that would mean fewer TRAs, right?
Exactly. But here's the kicker. The white paper says the use of TRAs and IPOs actually went up.
That's right. It seems companies are finding TRAs even more useful in uncertain times, which tells us something important. Despite the slowdown, the strategic use of TRAs, both companies and investors are recognizing this.
And it's not just small startups dipping their toes in the water.
Yeah.
We're talking big names like Birkenstock, Nextracker. They both use TRAs in their recent IPOs.
Yeah, this tells us that TRAs are becoming a more established and accepted financial tool, even for companies with, considerable size and clout. It's definitely a sign of a maturing market.
Okay, so we've got companies using TRAs, investors like Parallax's Capital, snapping them up. Everyone's happy, right? Well, not so fast. The white paper dives into something called liability management exercises, or LMEs. And trust me, this is where things get really interesting and a little bit risky.
Yeah, LMEs are basically, these are fancy financial maneuvers that companies can use to restructure their debt. Think of it like a corporate juggling act with loans and obligations.
Right, and sometimes those juggling pins get dropped.
Unfortunately.
And unfortunately, TRA holders can get caught in the crossfire.
Yeah.
The white paper highlights two key LME strategies, up tiers and drop downs, which kind of sounds like something out of a sci-fi movie. But they even give us some real-world examples, which I always appreciate.
Yeah, one example that really jumped out at me was Summit Materials. They essentially pulled off a move similar to an up tier, bringing in new debt and giving it priority over existing obligations, including some held by, you guessed it, TRA holders.
Oh, so imagine you show up at a restaurant, you're first in line, starting, ready to order, and suddenly
Uh-oh.
a whole new line forms cutting in front of you.
It's a bit like that, but with, potentially millions of dollars at stake. The white paper says this kind of move, while perfectly legal, can significantly impact the value of a TRA. They also highlight Vistracor, which did something similar to a dropdown. They used a complex exchange offer to try and limit their obligations to, again, TRA holders.
It's almost like companies are playing a game of financial chess, and TRA holders need to be aware of the moves.
Exactly, especially in the current economic climate. With interest rates higher than they've been in years, and a lot of experts talking about a potential recession, some companies might be looking for ways to, to manage their debt and free up cash, even if it means getting a little creative.
And not always in a way that benefits the TRA holder.
Which is why due diligence is absolutely crucial in this space. You can't just look at the potential payout of a TRA. You need to understand the company's overall financial health, their debt structure, their management team. Basically, you need to read the fine print and then some.
It sounds like TRA investing is not for the faint of heart.
It definitely requires a certain level of sophistication and risk tolerance. But that's why we're here, breaking it all down.
Exactly. And that's also why this white paper from Parallax's Capital is such a valuable resource. It doesn't shy away from these complexities. It lays it all out there and gives you the information you need to start asking the right questions.
And one of the most, I think, intriguing and potentially concerning complexities the white paper dives into is the changing landscape of take-private make-wholes.
This is where things take another turn, right? I mean, you'd think that if a company with a TRA gets acquired in a take-private deal, the TRA holders would be sitting pretty.
That was the conventional wisdom for sure.
Yeah. It was almost like a guaranteed payout.
Right.
A nice little bonus for betting on the right company. So what changed?
Well, it used to be that TRA holders would receive what's called a make-whole payment, basically cashing out their investment early when a company went private. But the landscape has definitely shifted.
Okay, so walk us through this because I'm already feeling like I need to be taking notes here.
So the white paper found that since 2021, most take-private situations haven't resulted in full payouts for TRA holders. Some are getting partial payments, and some, shockingly, are seeing their investments completely wiped out.
You're kidding. Complete impairment. That sounds scary.
It can be, and it highlights the importance of understanding the power dynamics at play in these deals. The white paper actually cites a case where a company kept their TRA holders completely in the dark about how their investment would be treated during a take-private.
They only came clean when lawyers got involved. That's wild. And we'll be right back after a quick break to unpack more of these twists and turns in the world of TRAs. And we're back diving deeper into the world of TRAs where, as we've seen, things are rarely as simple as they seem. Before the break, we were talking about how the landscape of take-private deals has shifted, with TRA holders facing a whole new level of uncertainty.
Yeah, it's true. What was once seen as a fairly predictable scenario, a near-guaranteed payday for TRA holders, has become much more complex and potentially risky.
So how does a savvy investor even begin to navigate this new terrain? What should they be looking out for?
Well, the white paper lays out a few crucial questions every TRA holder should be asking themselves.
Okay.
And I appreciate that they don't just present this as some kind of checklist, right? They really frame it in a way that helps you understand the underlying dynamics and the potential conflicts of interest that can arise in these situations.
Give me an example. What's the first red flag an investor should be watching out for?
Control.
Okay.
Pure and simple. They need to ask themselves, as a TRA holder, do they have a majority stake? And if not, who does?
Because if you're in the minority, you're essentially along for the ride, right? You're at the mercy of the majority holder's decisions.
Precisely. And this is where things get really interesting. If the majority holder is purely focused on maximizing the TRA's value, great. But what if they have other incentives? What if they're also part of the management team negotiating a take-private deal?
Right.
Suddenly their interests might not align with yours.
It's like being invited to a poker game where everyone else seems to already know each other's hands.
Right.
Not exactly a recipe for confidence.
A great analogy. And that's why the white paper stresses the importance of digging deeper, asking questions like, are there any substantial tax assets held by the company that aren't tied to the TRA?
Because that could impact your potential payout down the line, right? Like finding out there's a second treasure chest hidden somewhere, but your map only leads to the first one.
Exactly.
Yeah.
And then the final crucial question Parallax poses is this. What's the likely payout of the TRA compared to the overall value of the company? Because a big payout might sound impressive on paper.
Right.
But if it represents a tiny fraction of the company's actual worth, you might not be getting the full picture.
It's all about understanding the bigger picture and your place within it, not getting distracted by shiny objects. Now, aside from navigating the potential minefield of LMEs and take-private scenarios, the white paper also looks ahead, making some bold predictions about the future of the TRA market. And one that really jumped out at me is that while they predict fewer new TRAs being created overall, they also predict the market size will actually grow.
It does seem counterintuitive, doesn't it?
It does.
But their reasoning actually makes a lot of sense. They believe that while the IPO slowdown will likely reduce the creation of brand new TRAs, existing TRAs will be traded more frequently in the secondary market.
So it's not about the number of TRAs being created, but how they're being bought, sold, and leveraged within the market. It's like a smaller pond with bigger fish swimming around.
Exactly. And here's where it gets even more interesting. Parallax predicts that it won't be the mega funds driving this adoption of TRAs.
Ah.
but mid-sized companies.
Now that's surprising. You'd think the big players would be all over this. What's driving that shift?
Two words, or rather acronyms, CAMT and Pillar 2.
Okay.
These new tax regulations are designed to limit the kind of tax optimization strategies that mega funds often employ.
Okay, so we need to break this down a bit. What exactly are CMT and Pillar 2, and how are they impacting the TRA market?
Sure. Well, CAMT stands for the Corporate Alternative Minimum Tax.
Okay.
It essentially imposes a minimum tax on corporations with very high profits, regardless of deductions or credits. Think of it like a way to ensure that even the most profitable companies are paying their fair share.
Okay, that makes sense. So no more slipping through the cracks for these massive corporations. And what about Pillar 2? How does that fit into the equation?
So Pillar 2 is a global agreement, spearheaded by the OECD, to establish a global minimum corporate tax rate of 15%.
Okay.
This is intended to discourage companies from shifting their profits to low-tax countries, commonly known as tax havens.
Ah, I see. So both CAMT and Pillar 2 are closing loopholes and leveling the playing field when it comes to corporate taxes. But how does that impact the TRA market specifically?
Well, these regulations, they take away some of the financial incentives that made TRAs so attractive to mega funds.
Right.
They're less able to use those complex tax strategies that TRAs often rely on.
So the playing field has shifted, and middle market companies who are less affected by these new regulations are the ones poised to benefit most from TRAs. It's like a whole new door has opened for them.
That's exactly what Parallax is suggesting. They see a huge opportunity for TRAs to become a more mainstream financing tool, particularly in the middle market.
Fascinating. So we've got a potential shift in the types of companies using TRAs, and the white paper also predicts a rise in what they call non-Up-C TRAs, which, I'll be honest, sounds pretty technical even for this conversation.
It is a bit in the weeds.
Yeah.
But essentially, these non-Up-C TRAs, they leverage a broader range of tax assets than traditional Up-C structures, which primarily focus on depreciation and amortization.
So it's like expanding the menu of tax benefits that can be packaged into a TRA.
Precisely. And the white paper provides some interesting examples.
Okay.
Driven Brands Holdings, for instance, included a TRA in their IPO that covered not only depreciation and amortization, but also net operating losses, or NOLs.
NOLs, those are like tax credits for past losses, right?
That's right. Essentially, a company can use past losses to offset future profits for tax purposes.
So they're monetizing those past struggles. I like it. It seems like the world of TRAs is getting broader and even more creative.
Absolutely, and this evolution is part of what makes the TRA market so interesting to watch.
It's like a financial laboratory where people are constantly experimenting with new formulas and strategies.
Very apt analogy.
Yeah.
But as with any experiment, there are risks involved. And speaking of risks, there's one more prediction from Parallaxes that I think we need to unpack. They issue a warning about inexperienced investors, what they call tourists, entering the TRA space.
Tourists. So we're talking about people trading in their beach umbrellas for spreadsheets and financial statements. What's the concern there? We'll dive into that right after the break. And we're back, wrapping up our deep dive into this fascinating, ever-evolving world of TRAs.
It is fascinating.
Before the break, we were talking about how this specialized corner of finance is attracting a new wave of investors, what you called tourists.
Right, the tourists.
Should seasoned TRA players be worried about this influx of newcomers?
It's certainly something to keep an eye on.
Okay.
Parallaxes seems to think so.
Yeah.
They argue that the increasing popularity of TRAs, combined with their inherent complexity, could attract investors who are, well, ill-equipped to handle the risks.
It's like going on a whitewater rafting trip without a paddle, maybe even a life jacket. You might enjoy the scenery for a while, but you're bound to hit some rapids eventually.
Exactly. And here's the thing.
Yeah.
If a bunch of inexperienced investors jump into the TRA market without really understanding what they're getting into, it could end badly for everyone.
Right. It could tarnish the whole industry's reputation.
Yeah.
So what makes TRAs so different from, say, traditional lending? Why is this expertise so crucial?
That's a great question, and it gets to the heart of how TRAs work.
Okay.
See, with traditional loans, investors typically have some kind of recourse if things go south.
Okay.
They might have collateral.
Right.
Or the company might be obligated to, prioritize their loan repayment.
So there's a safety net, a plan B if things go wrong.
Exactly. But with TRAs, it's a different story. The white paper emphasizes that TRAs are largely risk-off transactions for the seller.
Okay.
If the company stumbles and can't make those TRA payments, investors, they have very limited options.
So you're really relying on the company's ability to actually generate those future tax benefits.
Precisely. There's no guaranteed safety net.
Yeah.
And that's why due diligence, experience, and a deep understanding of the company's financials and the broader market are absolutely crucial for TRA investors. You need to be able to assess those risks and make informed decisions.
And it sounds like it's not just about understanding the numbers.
Right.
The white paper also talks about the importance of relationships in the TRA space. What's the dynamic there?
That's another key point, the relationship between the TRA investor and the company sponsors. That can make or break a deal.
Okay.
In traditional lending, sponsors often have a strong incentive to support the company if it hits a rough patch. After all, they typically have their own money on the line.
They're invested in the company's success, so they're more likely to step in and help if needed.
Exactly. But with TRAs,
Yeah.
the sponsor has already sold those future tax benefits. They've gotten their payout.
So their incentive to go the extra mile to provide that same level of support might be diminished.
That's the potential risk.
Yeah.
And this can create tension, even conflict, between TRA investors and sponsors. It's something experienced players are very aware of.
So navigating this market requires more than just financial acumen, right?
Right.
It's about understanding the motivations, the incentives, the potential points of friction between all the players involved.
Precisely. It's a nuanced game.
Yeah.
And that brings us to what I think is one of the most intriguing parts of this whole white paper.
Okay.
Parallax's comparison of the TRA market to the pharmaceutical royalty sector back in the 2000s.
Okay.
And even the music royalty space more recently.
Okay, so help us connect those dots. What's the parallel here?
Well, both of those sectors, they saw a huge influx of capital,
Right.
new players. There was, kind of a gold rush mentality with everyone eager to get a piece of the action.
And some came out on top while others not so much.
Exactly. Some players, like Royalty Pharma in the pharmaceutical space,
Right.
and Hypnosis in music, they managed to, consolidate power, become major forces.
Okay.
Others struggled to compete or made costly mistakes.
So is Parallax's suggesting we might see a similar shakeout in the TRA market? It's possible.
Okay.
Their white paper doesn't offer a definitive answer,
Right.
but it does suggest that competition is likely to intensify as more investors recognize the potential of TRAs.
So how can investors, and maybe even just interested observers like us, tell who's going to come out on top? What separates the contenders from the pretenders in the TRA world?
That's the question, isn't it? Well, Parallaxes highlights a few key factors.
Okay.
First and foremost, deep domain expertise will be crucial.
Okay.
It's not enough to just understand the basics. Successful players will need a nuanced understanding of the tax code, the ability to analyze those complex financial structures we've been talking about, and the foresight to, anticipate those potential pitfalls.
It's like being a financial detective, a tax attorney, and a chess master, all rolled into one. That's a great way to put
It
it.
really is, yeah.
They'll also need a strong track record, a proven ability to identify and execute profitable TRA investments.
Right.
Past performance isn't everything, but it does matter in this space.
Yeah, experience counts. And what about relationships? We talked about how crucial those can be.
Absolutely. The winners in the TRA space will need to cultivate strong, trusted relationships with key players in the private equity and IPO ecosystems. They need to be seen as reliable, knowledgeable partners who can navigate the complexities of these deals.
So it's about building a network. But instead of swapping business cards at a cocktail party, you're swapping term sheets and financial statements.
Precisely. And with that in mind, Parallaxes leaves us with this final thought-provoking question. As the TRA market matures, will it follow the path of pharmaceutical royalties, with a few dominant players consolidating power, or will it chart its own course?
That is a fantastic question.
It is.
Will we see a handful of TRA giants emerge? Or will a more diverse ecosystem take hold with specialized players focusing on specific niches? It's like watching a financial thriller unfold in real time.
And that's the beauty of a good deep dive, wouldn't you say?
Yeah.
We've gone from, 0 to 60 on TRAs.
We really have.
From the basics to the big picture trends, hopefully spark some curiosity along the way.
Definitely has for me.
Good.
Yeah. We've explored those potential rewards, uncovered those hidden risks, and maybe even learned a few new acronyms along the way.
Always a plus, right?
Always a plus. So, as you continue your own financial explorations, remember what we've discussed. Ask those tough questions, do your due diligence, and never underestimate the complexity and ever-evolving nature of the TRA market. And who knows, maybe UALL will be the one to predict the next big twist in the TRA tale. Until next time, happy investing.